I'm Rajiv Menon. I'm a student of multifamily real estate and learning the ropes. I'm co-hosted by Philippe Schilligan and Jeff Rodriguez. I think Jeff is not able to join the call yet, but Philippe and Jeff are co-founders of Boost Capital Group, and Philippe is a resident expert on multifamily real estate, and he's presenting his work and sharing his knowledge with multifamily investments and his expertise. So,
Right.
I think today's topic is how do
No, but
macroeconomic factors affect real estate investments? So, please go ahead, Jeff. Please go ahead, Philippe.
Okay, yeah, thank you, Rajiv, for the introduction. Welcome, everyone. And we are not in the usual setup, and we're going to mute microphones. I think hopefully Jeff will be with us shortly. I think it's our fourth event, and as Rajiv mentioned, tonight we're going to talk about how do macroeconomic environment affect or the macroeconomic environment affect an investment. As usual, we're talking about the in-place commercial multifamily value add, very popular strategy. And feel free to ask any question you may have. We're a small group. We're still building up our little community here. And otherwise, the meeting is recorded. We'll share it. We're building some kind of a backlog, and then we'll share everything on YouTube, on our YouTube channel. And we are doing part education, about 30 minutes, and then about 30 minutes in networking, though I may not be able to stay for the second part due to unusual circumstances as I'm at an event here. So to start on things that are impacting an investment, I think it starts with the assumptions that we're going to make or the forecasts we're going to use when we are preparing the underwriting of a deal, or so-called pro formas. We're going to put all the numbers together, and we're going to take into account a set of parameters, a set of assumptions or forecasts pertaining to the rent growth. And here I'm talking about how the market is going to grow. The rents are going to grow on the market beyond bringing the rents to market, or doing renovations to be able to bring rents to market. So we're looking more like at the economic environment. And the other, one of the other topics is we're going to also look at expenses growth. And for those two topics here, I took a little bit of a screenshot. In our models, we're going to have an annual rent escalator as well as an annual expense escalator. And on a yearly basis, we're going to define what kind of escalation from year to year we're going to have. And so we'll go typically use the inflation as a guideline, especially, and I'll come back to that in a few minutes, actually. And also about the rent growth, also I'll dig a little bit deeper on those two topics in a few minutes. But another topic or thing we want to look at is the vacancy going forward. What kind of vacancy we're going to have, what's the forecast on that, and I'll touch on that topic as well. And also cap rates, a little bit of an introduction. How do we talk about rents, vacancy, and cap rates? So here, two of the three. On the next slide, there will be the cap rates, but we're using a information, and I like very much this company, CoStar. They're doing a lot of analysis, the gold standard on analyzing markets, but also they put their own other companies who are either managing data pertaining to real estate, or they have listings for commercial real estate. They own a company that's called Net. So they gather a lot of information, and then they have a team of analysts and economists who are going to make forecasts. And when you ask a report, they'll be able to provide a report that is specific to a particular market, or even sub-market, and even specific to a property. And they're going to provide, I'm showing two illustrations here, a historical how, for instance, on the left, the rents increased in the past, but also they're going to provide a forecast, as I mentioned, the economist, of what they think based on information they have, you can observe in the future. So actually, in the writing I'm showing here, it's exactly pertaining to that particular deal that we worked on. And here we use year 2 and 3 use 3% for rent escalation. And if you look, so it's in Augusta. If we look the orange bars year over year, so if you look, let's say a year from now, we're third quarter, so that would be here. So we have a little bit above 2%. Maybe we're a little bit on the higher side, though, as you could see here, for year one, we use 0%. On average, we're 1.5, so we are really below what the forecast is. And year 3, we're showing 3%. I think if we look at year 1 here, year 2, year 3, we are looking at close to 4% in both of these cases. And the way I'm looking at it, I try to do my underwriting in a more conservative manner than what the forecast is. I went like in depth in the explanation. Oh, go ahead, Rajiv.
Yeah, I had a quick question. For the Costa report, it always shows a forecast of how the market is going to do in the future, 3 or 4 years. So how accurate are these forecasts typically?
Like any forecast, it's based on the best assessment that you can do and that economists can have. But I think so that's one part of the answer, right? So you're making an educated decision
Yes.
and on what number you're going to use, and you want to be in line with, let's say, the general consensus. I think the other side of your question is you're going to stress test the your underwriting, your pro forma, and basically, so going back here, for instance, I have 3% here. What happens if I only get to 2% or 1% or 0%? So that's where you're going to stress test what are the returns are going to look like. And I would say probably the even better, stronger stress test, one that I like very much, is a stress test on occupancy, right? So for how long can I pay the mortgage on the property with all things being considered in income and expenses? With, let's say, can I pay the mortgage with 90% occupancy, or 80% or 70%? 70% is a very healthy number to be at. For instance, if you can not be in trouble with your lender at 60-70% occupancy, you're in a good position, and it's going to be,
Okay.
you're increasing the odds that you'll be able to withstand a downturn in the economy.
Okay.
And on the same, I said, like the cap rate as well. If you remember, maybe I should have put the formula there, but cap rate is the net operating income divided by the price or valuation of a property. So for instance, here you have, this is how the cap rate acted in the past, and this is what the forecast is. So the forecast, I'm going to talk next slide about what we do about that particular forecast. But what's interesting, and I think looking at the other macroeconomic components of the environment, I'm showing in light blue here on this little chart from the Fred website, which is the Federal Reserve. The light blue is the federal funds effective rate, which in other words, that's the famous Fed rate for lending money. Is moving a lot of things throughout the economy. And if we just compare, for instance, what's happening and how things could be related, we see in the 2006, 2008, there was an increase in the Fed rate, and that corresponded at eventually some increase in the cap rates. Then there was a recession, everything went down. And what was interesting in this 2017, 18 up to 20 time frame, the rates went up, but much more slower, and the cap rates continued to compress, meaning that people saw more and more value in that case in the assets. And in 22, rates went up dramatically high in a short time frame, and now you can see that had an impact on cap rates because they expanded, meaning that the prices went down, right? And I'll come back to a minute of kind of the link on that. It's just to illustrate a little bit like how things can happen. It's hard to be perfect on the forecast, obviously. And I think the other thing that I'm illustrating here is this dark red color is the CPI, or in other words, also known as inflation. And you can see that in obviously more recently, the CPI, the inflation was really high, and then it came lower, and it was like a kind of an effect of all the money that was in the system during the pandemic and after the pandemic. That created a lot of inflation as well as disruption in supply chains and whatnot. Obviously, when you underwrite, and I'm going to come back to this slide here, your expenses can, if you had 3%, and now all suddenly you really experience the 7% inflation on expenses, this has an impact, right? And I go back to what I mentioned earlier, like the way you want to anticipate this type of thing is you're going to stress test the returns of your investments by changing some of the parameters. What if inflation is going higher? And for instance, in that case, would be a good thing to test. And I go to the next slide. So another way to look at that. So I would say these percentages, increase rent, increase of expenses, what kind of inflation you're going to use. You use the stress test on those to see if you can sustain a kind of a downturn, like something, the economy be in a tougher position. Can you sustain, can you continue to manage the property and make money? Another way that we use to protect ourselves when we look at deals is we're going to take into account into calculations and the time of ownership. For instance, here, let's say I'm buying a property in Dallas Fort Worth, and the market cap rate is about 5%, and I'm going to hold that deal for about 5 years. But I take into account cap rate expansion of 0.1% every year. So now, in that particular case, it's interesting. The result will be at 5.5, pretty much more or less in 5 years. And you see, it's more or less. I did this thin line, kind of a extension of that trend on cap rates, but you can see how you can protect yourself from an economic environment going forward, so that you're going to incorporate to your underwriting.
Philip, if you anticipate the cap rate significantly reducing in the future, would you make a decision to sell your asset earlier when the weather is good? Like when it's a good environment to sell the asset?
Yeah, I think what was, and I think I'll use an example to illustrate how we thought about a specific case, because I think every situation is going to be a little bit unique. But obviously, at the end of 2021, if you remember what was happening, is like we started to have inflation going up and up and up. And as a result, the Fed said, and there's a significant lag of a year at least, they said, oh, we're going to increase the rates starting in 2022. So they said at this time frame, we're going to, and sure enough, when the rates went up, that's when the cap rates started to go up, because the direct effect of the Fed, the decision to increase the rates, is that to borrow money from lenders, it was more expensive. So it's more expensive to borrow money from lenders, it means that you can offer less. on a property. So I think, in all fairness, during 2021, or let's say second half of 2021, when the Fed said, "Oh, by the way, we're going to increase rates," that's when you should have said, "Oh, now is a good time to sell," right? So because and without being necessarily like an expert in macroeconomy and whatnot, this increase here, it was a signal that rates were going probably to increase. But eventually they said at the end of 2021, they said, we're going to increase rates like 6 months before it happened, because they said we need to curb this inflation. And sure enough, they did it, and it happened. And cap rates turned because money was more expensive to borrow. I think that is something you need to stay on top of. Was the macroeconomic environment? Absolutely. And then you can hopefully pick like a better time to get out. And it was, and what happened here, if you look, I think if you look, so we are in the 2020, 2021 acceleration of the cap rate going down, meaning that all the prices went up. And that corresponds to this. All suddenly, the
Philippe, I think Philippe got stuck there. His call has got stuck. Can you hear us?
Okay, I think what Philippe was pointing out is the correlation between the cap rate compression, prices increasing, and then the rents increasing as prices increased. So I'm not sure he's going to be able to hop back on. I think he had maybe a couple more slides left, but we're not going to hold you guys too long. There he is again.
I'm sorry. I guess we lost.
Yeah, it's fine.
You lost me for a second. Shared. Is my screen shared?
No, it's gone.
No. Okay. I guess you made it eventually. Slideshow. Okay. Yeah, I don't know when you lost
You
me.
were
or I
talking
lost
about the
you.
cap rate compression, and then in regards to the increase in rents year over year.
Yes. Yes. Yeah. So end of 2020 started to see an increase of rents. 2021 super high. 2022 it started to cool down. Different markets looks a little different. You could see that exactly this 2020 particularly. So 2020 started to have cap rates started to compress at the beginning of the rent increase phase, and then 2021 was the worst. It was like went super low. But and again, we knew at that point the Fed was increasing rates. That had an effect to increase the cap rates, and that was the best time. So they certainly keep an eye on the market. But I would say in general, you certainly want to. It's good practice to use, and that's what we use. And I think it's very common practice too, to use cap rate expansion to take into account something happening in the economy, right? So obviously, if you use the same expansion and you purchased here, you're probably a little bit behind the reality of things. But that's where I would say, hopefully, you did the sufficient stress test in order to be able to avoid having to sell at the wrong time. So cap rates, they're going to come back eventually to some more lower numbers. So and then it will be a good time to sell. All right. Yeah, and as usual, it's something we can spend a lot of time on. So I just added a few other or general considerations. We spoke about interest rates. We spoke about economic growth. I think it's linked. It's closely tied to probably inflation. Supply and demand is more like about population. That's why we rents are going to be high in places where there's a lot of people moving in. That's why for us it's a very important factor to be in those markets where there is growth in population, which is usually tied to economic growth. And I would say I try not to to anticipate the growth based on news that some people may decide to move their company or whatever in some places, because unfortunately often things are changing, and when they are announcing a bunch of things and the reality is a little bit different, there are delays, there are people fighting, whatever. I know an example, there was a electric vehicle company that was supposed to move. You are looking at this market in Atlanta near Conyers, and eventually, for now at least, it's not happening. So if you're trying to, that's why I'm looking more at population growth. This is the reality of things. Yeah, maybe I'm not going to bet to get the best prices because now everybody's looking at the same thing, but I'm not betting on something that may or may not happen. Government policies, also something to probably keep an eye on. I would say we try to be landlord friendly. States policies and politics are changing all the time, something to stay on top of. Financing availability, it's a good topic. When COVID hit, all suddenly the banks, the lenders, they just had like different requirements and they expected to have more reserves. Like, so as a result, to achieve whatever returns you were targeting, you had to lower the purchase price again, which is interesting actually. If we observe the cap rates, that didn't affect the cap rates too much, but in reality, I think there was a little bit of a people who were overconfident about the market at the time. That's why prices went up, and they ended up paying more than what they should have, for sure. Consumer confidence, I think this one is an interesting topic because I would say it's certainly tied to the economy in general. But I would say, as us, when we are putting our opportunities together, I think people's confidence in what the economy, where the economy is and the market is, and should they invest or not, has a big effect. I would say these days it's certainly a little bit tougher to raise capital, and that it shows also it's a reflection on how much we can offer on some of the properties. Last bullet point here, market location. Like I mentioned before, I think the biggest piece there is the effect of supply and demand and how many people are moving into that market. Yeah, those are things in terms of considerations to take into account. But as a kind of conclusion, obviously many factors to look at, but the tools to answer these concerns is going to be stress test the returns, particularly on occupancy. Make sure that you can pay the loan payments with lower occupancy. It's one thing to have lower returns because there's a downturn of the economy. I think everybody will understand that, but we certainly don't want to lose your money. And also, and I don't know if I mentioned that earlier, but we want to look at your reserves because, for instance, if let's say doing your stress test, you realize that you may be in a tough spot in a particular scenario, the answer to be able to and go through that scenario is just to have some capital reserves that you can use to pay the loan, to make the loan payments, for instance, or and be able to keep the property flowing, and you'll be able to sustain. I know some people are talking about, there's going to be a recession. Obviously, it's tough on the ability of people to pay rents, and this is what we need to test. Again, go back to occupancy, stress test, and so on. And between that and having reserves, that's the way to be able to have successful investments.
So, Philip.
Yeah, Rajiv.
Philip, Mark has a question. So, cap rate you should strive for?
Minimal cap rate. Personally, okay. So I would say that depends on what's your strategy. Yeah, because so we do in place multifamily value add, meaning that we're buying an asset, an existing asset, which helps to mitigate the risks of developing it from ground up. And then we're looking for an asset that we can usually buy at a discount and that has rents that are below market, like a very simple, typical business plan. So from that standpoint, if we can add value to the property, if you can increase its value by doing renovations or improving management, etc., the cap rate and what are the interest rates and so on, it's not as critical as if you were to buy an asset that
I think he froze again. Something to consider is minimum cap rate. That'd be dependent on what market you're investing. A cap rate, there'd be more compressed cap rate in a Austin market versus a market in Mobile, Alabama.
if you're borrowing at 7%.
Yeah. The question is it what would be worth it or not worth it to invest your money to buy a property if you couldn't, with normal occupancy, get the rent rate that you're looking for?
Yes, the cap rate that you're going to get be based off after you get all your ducks in a row, your financing, if you're buying any additional rate caps, right? And then your exit strategy, what would be the exit cap rate? Honestly, years ago, people were buying at 3% cap rate a property. It could be an A class property, but if you're in a B class neighborhood, or so there's a lot of things that are to take into consideration, and like there's no specific answer. I think maybe if you ask, I'm looking at an A class property in the Dallas, Texas market with 250 units, then that would be, and the calculation gives you a 2.5%, 3% cap rate. That's way too low. I guess it would be situation dependent on the market and the class of asset that you're buying, as well as, is it a self-storage or is it multifamily? Is it a mixed use? There's several variables to consider there, and I hope that makes sense.
Yeah, it does, but it's a whole varied world out there, city by city, property by property.
And there's comparisons. The CoStar reports, you're able to look at what things sold for and be able to come up with some kind of idea of where the cap rates are going. So we use a lot of macroeconomic data to use to forecast what things would be in play down the road compared to what's happened in the past. There's a lot of things like that to consider, but if you're in a specific market, it's easier to identify, okay, I'm working in Dallas, Texas. This is a good cap rate to go after based on an A class, B class, even C class type of property. Does that make sense?
Yes.
Okay.
And then my next question is there a checklist once you buy a property, improvements you can do on it to protect the property or gain extra value with the property, so your cap rate looks better?
Obviously, expense of the turnover, right? If you're putting in $15,000 into a C class property that you're only going to bump rents up a certain amount of money, that doesn't make sense. There's that to consider first. You will obviously be working with a property management company for larger units that would be able to provide a list of items based on their experience in that specific market of what would bring you those rent levels, right? That's why it's very important to have a property management company in a market that you are not very familiar to help you out with those with that checklist. Obviously, you as the investor, the buyer will obviously have a lot of say. I want granite countertops, stainless steel appliances, this, that, and the other hard floors, but is the increase in that checklist going to give you the rent bump that you need in order to be able to pay the debt service? There are checklists out there, but it's all depending on what the property needs for improvements. You need obviously your basics, making sure that all HVAC works, the roofs are all working, there's no flood issues, and the basics needed in order to have a tenant in there. And everything else is basically if you want to do a premium upgrade from a classic, or do you want to go platinum? So there's different levels, different checklists, but it all boils down to what you want and what your property management company suggests is viable or feasible for that market and that property.
Okay.
I hope that answered your question.
Yeah, it did. But then now I have 50 more questions, but oh,
we welcome all questions. Absolutely. We're here to help. We have a lot of like information and stuff like that. But what else do you have?
Oh my God. All right. From what you're telling me, I almost think that 15% of any acquisition just comes down to luck or just a gut feeling that this property will turn into a winner versus this property over here across town,
I would say more of an analysis and using boots on the ground and bringing in the right team, the right finance, and the right contractors to put in this whole business plan and put it into work is the important part of it. So it's not really a guessing game. It's more of an analytical approach to identifying everything that needs to be done in order to have a good product. If it's a C class, you got to compare. If someone's telling you that you got a C class and you can increase rents $500 the first 2 years, but everything else around there is not going to meet that criteria, there's those considerations, right? That's a basic, really low level example, but that's when the right team to help you out and to partner with is very crucial, so that there's things like that are just crossed off. Okay, that's not going to work. That's not going to work. These are the things we need to focus on.
Okay, then question number 2, 3. All right, you have a property management company, and of course you have net operating income. What is the ratio of net operating income you want to expenses of the property? For instance, you have taxes, you have maybe improvements, some of them lawn care, monthly expense for the property management company, or maybe what would you say that ratio would be to hard expenses versus actual net operating income, where you say I've got to have it 20/80 or it's not going to work? If it's 25/75, I'm probably paying too much, or I may not be making enough money to cover. But and I know everything's different, so but just a general rule that you guys see.
Obviously, starting off below 50% is a start off. Now, if during underwriting, the underwriting process that we use has a breakdown as far as percentages goes. Let's say a property management company is charging 3 to 4%, and it breaks it down to how much based off the income that property management company is going to make or take out. And then we have things from lawn care to all those contracted services. And I guess you're asking for a solid number in regards to is going to be 35% of the income in order to make this property work and collect service debt. There isn't a magic number that covers everything, that blankets everything. If you're paying more than 50% for expenses, then the deal most likely is not going to work. Below, and then just drilling into all the specifics of each line item is what's going to help you identify if this is a good asset to go after. That's why there's a lot of underwriting that takes place. You can underwrite 100 deals before you even get 3 that come to the table and 1 that's even worth it. So there's a lot of underwriting, a lot of these analysis, and things are changing. The cost of material has skyrocketed. If you're not working with a property management company or a developer or a contract company that can give you the up-to-date cost of things, you can under-calculate. And then when you get to the table, you realize, oh, wait, we under-calculated this, so now we got to go back and fix this. So there is but so much time to underwrite these deals, and you don't want to spend too much time figuring everything out as you go. The biggest expense items, I would say, and Philip, let me know if you agree, is taxes and insurance will break a deal real quick because those costs have skyrocketed, and I'm sure you're aware. And then based on the market, the taxes, it can change from acquisition, or it could just change in 5 years from the last assessment. So there's things to consider, that maybe a someone underwrote those deals and without expecting a change in taxes, but once the property is sold, then they get reassessed and it could double just that easy. So those are some things to consider that would increase that percentage you're talking about as far as the income ratio.
And you said insurance is a major expense too, on that 35 to 50%.
The insurance is a major expense within all the expenses. That's one of the largest expenses, especially here lately in the past few years. Insurance, just because everything has gone up, the price of construction, labor, material, everything has gone up. So that has increased the prices of the insurance, the coverage for insurance.
That's good news to me. I have a company that can mitigate loss due to fire and water leaks at least 50%. So it should help out on insurance costs. But that's interesting. All right.
Ed, do you have any questions that you can stump us with?
All right. Yeah. Go ahead, Jeff. You were gonna.
All right. Yeah. So if there's no more questions, and
Oh,
if you do have any questions,
Oh, I do have one.
oh sure.
When a company or entity or person sells, say, rental property, is it usually how many times is it usually it's at the top of its game, and they're charging you a premium price, or how many deals can you find out there where they undervalue the property, or is it just depends?
Okay. Just to better understand your question, you're asking, so there's X number of deals out there, and some have an additional premium for that specific deal. How many of those are out there? Is that what you're asking?
No, how many people sell the property and are really uneducated on the price they should charge is probably a better way to phrase it.
Okay. Yeah. So a lot of the deals we are involved with come through brokers, which know the market and they know the property and they know what is a proper price point. Even though they work with the owner, the seller, right now there is still a disconnect between seller and buyer prices. Sellers are still nostalgic with the prices of 2021, 2020, 2021, right? And buyers know that the market has changed, but there's a big delta, a big gap between the buyers and the sellers. So the broker is going to list it as what the seller is comfortable with. You don't want him to lose any money. But as a seller, we have to assess every single thing and know that those prices, while they were okay 2 years ago, they are no longer okay to go after because of the interest rates.
Gotcha.
Right. So there is that disconnect still. Maybe in the next year or so, 6 months, maybe we should see more of those prices come down. There's a lot going to foreclosure out there right now. So there's those deals to look at. But a lot of those brokers go to teams they've already closed deals with before they take them to the market.
Gotcha. Because it's a lot less work. They know they can get done. Yeah. Nice.
Absolutely.
Okay. All right. Well,
all right. So I think we have pretty much 7 minutes left, but we thank you for stopping by. I actually was supposed to present about debt funds, but that would be for the next time. We're going to talk about what a debt fund is, how they operate, what they are, and who can invest in them. That'll be for the next Thursday, I believe. That's all for today. I thank you for stopping by and look forward to seeing you guys next time.
Thanks, everyone.
Okay. All right. Thank you.
All right. Thanks, everybody.
Thank you.